Now, if there's one topic I am utterly tired of discussing, it's people telling me, this is going to be like 2008, right? Or, dude, this is going to make 2008 look like nothing. Let's have a chat, shall we? I'm exceptionally bearish on this market. I've covered that sentiment for quite some time, if you've been watching my videos. Now, I've broken this topic into two parts. Now, in this video, I'm going to explain why this correction, or crash, is nothing like 2008. In part two, I'm going to explain how and why the imminent recovery will be so much faster and why eventually I see prices surging right back up. Now, to understand a bubble or a crash, you first need to understand how we inflated that bubble. So we're going to look at two major categories. First, who and why were people purchasing? Second, let's compare the lending environments that established this behavior. Las Vegas, Arizona, and South Florida were the epicenters for growth during the early 2000s. Living here in Las Vegas and recently licensed as a realtor back then, I experienced this phenomenon firsthand. So let's go back and set the stage for the first bubble. Back in 1999, President Bill Clinton repealed the Glass-Steagall Act. Without getting too deep into it, it opened the door for commercial banks like Wells Fargo to invest and operate in more risky ventures like their counterparts, say Merrill Lynch and Goldman Sachs, they were able to do as investment banks. As a result, this sparked a major insurgence in investment banking and promoted mortgage-backed securities. Now, on the ground level, that meant that banks now had an insatiable desire to loan money so they could bundle them into securities and then go ahead and sell them off on Wall Street. As a result, overnight, everyone was able to get a loan. Stated income loans were originally created for business owners that had substantial income but couldn't show that income due to business write-offs to lower their tax liability.
Then you can write it off on your taxes.
Stated income loans had been around for a long time. Suddenly, everyone was able to fabricate their income to qualify for more than they actually could afford. Nobody cared that people were lying about their income because those loans were bundled and repurchased immediately. Essentially overnight, anyone could get a loan for virtually whatever amount they wanted. Now, as a result, demand spiked. Well, when demand spikes,
the price just went up.
Well, as prices rose, builders struggled to meet the demand and affordability began to become an issue. So, how did banks make payments more affordable? Hey, introducing adjustable rate mortgages. Now, you could get a lower interest rate for 2 to 5 years. Now, if that wasn't good enough, you could get an interest-only loan on an adjustable rate mortgage on top of it. So by this point, people who could afford a $400,000 home on a 30-year fixed mortgage were now able to purchase a $1 million home on an interest-only adjustable rate mortgage. Now that everyone could purchase their dream home at this point, prices just surged through the roof. Well, if you could own one home that was appreciating like crazy, imagine if you could own 10 homes. So just like the crypto boom, suddenly overnight, everyone was an investor. People who never owned a single investment property suddenly owned multiple. If you didn't have the capital to put money down on an investment property, hey, don't worry. Just call your friendly mortgage broker and he'll have his personal appraiser come to your home, overappraise it, and then cash out some of your equity so you can put that equity down on multiple homes. Now, brokers got rich, appraisers lined their pockets, and seemingly everyone was able to own multiple properties. And every valet driver and cocktail waitress I met here in Las Vegas owned multiple homes at this time. The scam was really simple. Buy as many new homes as possible and either flip it the very moment the home was built, or simply rent it out for a year or two until you reached enough appreciation to make the profit you wanted. If this sounds completely absurd, that's because it was. In hindsight, it was impossible for this to turn out any different. You had a nation of people with little to no business sense taking out risky mortgages for homes they couldn't even afford. Then you had these same people owning multiple rental properties that, in most cases, were losing money every single month based off of the speculation that they'd profit on multiple homes within a couple years when they went ahead and sold them. Now, the problem that no one wanted to see was the fact that there was really little to no legitimate demand here. You'd have a high-rise condo with 300 units sold to 200 investors who all planned on flipping their units upon completion. So once those units were completed, who are those investors going to sell to? Few people truly had an interest in living in these high-rise buildings. Now, at this point, the house of cards was fully erected. Eventually, you reach a point where prices are just too high for investors and supply starts to catch up to demand. Now, as a result, prices plateaued. Now, once prices plateaued, there was no more quick, easy money. No quick money meant it was time to bail. Investors started unloading and builders couldn't sell their new homes. Wall Street woke up one morning and realized that they were sitting on ticking time bombs. So suddenly, underwriting wouldn't approve people for loans. Mortgage banks went bankrupt overnight since they couldn't sell off the loans that they were sitting on.
So I shut down. I just declared bankruptcy, and now, well...
At the end of the line were us, the consumers. Once prices started falling, it was apparent that your investment property that was hemorrhaging money was never going to mature and make you rich. So the first step was to unload these worthless investment properties. As prices continued to decline, people realized that their adjustable rate mortgage reset, they wouldn't be able to afford the home that they were even living in. Now people started trying to bail on their personal homes. But with everyone liquidating and nobody purchasing, prices began to free fall. Suddenly, your home was worth half of what you paid, and banks initially declined to offer mortgage assistance or loan modifications. So people simply stopped paying and went ahead and foreclosed on their properties. In the end, America hung ourselves with our own rope. We bit off more than we could chew with nonsensical loans, over-leveraging by inexperienced investors with no semblance of a plan B if their hopes and dreams didn't come true. So now, let's go ahead and compare 2008 to our current situation. From a banking standpoint, the Federal Housing Finance Agency was established in 2008 to ensure that this would never happen again. Appraisers were separated from mortgage companies by establishing appraisal management companies. Heavy disclosures, timelines, and explanations were enacted to protect consumers from some of this predatory lending that was occurring and provide transparency and education to all these borrowers. Now, stated loans became obsolete. Adjustable rate mortgages became frowned upon, and underwriting standards were heavily increased. Today, it's not necessarily difficult to get a mortgage loan. You simply have to qualify for a reasonable loan. So if all these protections were put in place, how did prices jump through the roof? Simply put, mortgage rates became historically low. This once again allowed people to qualify for homes substantially more expensive than in years past. Now comes the who and why. Between a pandemic which created work from home and national political firestorms all over the country, never before seen migration patterns occurred. Wealthy and conservative people elected to free these liberal states and migrate to tax-friendly and more conservative states. Work from home meant that people no longer had to pay these exorbitant rental prices in urban areas like San Francisco. So with people spending more time than ever before at home, people cared more about their home environments. Suddenly, people not only were ready to move, but they also had access to cheap money. Cheap money means more purchasing power. More purchasing power means more consumption. More consumption leads to a higher demand, and higher demand leads to increasing prices. Now, the second component was unprecedented. In the early 2000s, we had a nation of inexperienced investors purchasing multiple homes. This time, we had hedge funds and institutional investors with access to ultra cheap money, purchasing single-family homes that normal people typically buy to live in. This had never been seen before. Institutional investors drove the prices of entry-level homes through the roof. Cheap money drove the prices of move-up and luxury homes through the roof, even as the wealthiest of buyers realized the value of leveraging. So why would you put another $1 million down on a home when a bank will lend me money at 3%? If I'm making 10% by investing that million, I'm still netting 7%, even with the debt service factored in. Which leads us to today. Prices got out of control due to cheap money and a historical migration pattern. Fine. Now that money has become expensive, people either cannot afford to purchase what they want or simply are unwilling to pay. As a result, demand has plummeted, which has led to these falling prices. Even with prices down 10% here in Las Vegas, the payments are still dramatically higher for the same home purchased in January at 3% interest. While prices are all but guaranteed to decline another 10% or more, not only will we not see the levels of decline in 2008, but the recovery is likely to be much quicker and much stronger than before. So consider the underlying foundation. Last time, you had people living in homes that they realistically could never afford. Not to mention, many borrowers had purchased with zero down payment and took out adjustable rate loans that were expiring and were no longer even being offered as an option. So contrast that with a nation of homeowners that actually qualified for fixed rate loans at historically low interest rates. Short of income or job losses, most homeowners don't have to sell their home. Before, we had investors owning multiple homes with negative cash flow on similar loans that were simply unsustainable. These were bad deals from the jump. It's no surprise these so-called investors jumped ship the moment their assets went down in value. Now, contrast with today. Small-time investors put down at least 20% on low interest rates and benefited from absurd inflation, which then led to increased rents. Now, even more dramatic were these institutional investors and hedge funds that purchased with even cheaper money and experienced absurdly high cap rates. So, if you're a homeowner on a 3% 30-year fixed mortgage that you can afford, why would you sell? So you can pay the same in rent, or so you can go move to the same home on a 7% mortgage? Nope. I'll sit on this for a while. If you're an investor, you put 20% down. Most likely you've seen substantially more than that in appreciation. Even if you're an investor who just purchased a property and will lose 20%, why would you sell if you're still making monthly positive cash flow? The ultimate goal is to pay off the property. If you're making positive cash flow, you can ride out the storm and eventually you'll be above your acquisition price once again. So why sell and lose money? In the end, the only comparison between 2008 and now is that prices are retracting. That's it. The underlying issues couldn't be more dissimilar. It's normal for housing markets to experience times of correction. While this may be larger than most, it's nothing like before. If there's one huge bright spot to this, simply look at our inventory levels. Despite record-selling low sales, the supply side of this equation is still very minimal because few homeowners are in a position where they need to sell. It's very unlikely this correction approaches 2008 levels or lasts 4 to 5 years like it did last time, which leads us directly into part 2, where I explained how and why a brisk housing recovery is actually likely to occur. So thanks for watching. Click to like and subscribe. Please share this with your friends and family, and click through for part 2 for a little dose of positivity amongst all this doom and gloom, guys. All right, thanks again. I'll see you on the next one. Deuces.